talk about capital budgeting. Capital budgeting means the company's thinking about making a long-term capital expenditure, maybe a new plant, maybe a new piece of equipment, maybe a new building, and we have to figure out whether it's a good idea or a bad idea. One of the simplest methods is the cash payback. So we'll look at the cash flow from a project. Usually means the net income plus the depreciation added back, because depreciation is a non-cash expense. And we'll see how many years it takes us to earn back our original investment. So the one thing that the cash payback period does right is it does look at the cash flow. So let's say this is project A, we spend $1,000, we get $500 back the first year, $500 cash back the second year. Project B, same price at the beginning, the initial outlay is $1,000, we get $900 back the first year and $100 back the second year. Project C, same thing, except we have another $100 out here. So what is the payback period? Well, for A, it's 2 years. For B, it's 2 years. After 2 years, we've got our $1,000 back. Same thing for project C. So under the payback method, all these have exactly the same payback period. However, B is better than A because we get our money back sooner. We get $900 back that first year that we can invest in our business right away. C is better than all of them because not only do we get our money back faster, but there's a cash flow that occurs after we get our cash back. So the two problems with the cash payback method are it ignores the time value of money, that we'd rather have our money sooner rather than later, and it ignores any cash flows after the payback period. The last thing that's a problem with the cash payback method is, suppose the company says you have to get your money back within 1 year or 2 years or 3 years. That's just an arbitrary number that management made up. A better way to look at it is to use a method that takes into account the time value of money and our cost of our money. A better way to evaluate potential capital expenditure projects is to use one of the methods that takes into account the time value of money. In other words, we'd rather have $1 today than $1 tomorrow, because if we have that dollar today, we can invest it and have that much more money tomorrow. So let's find the internal rate of return for these projects. In other words, what do these projects earn? Well, we just get our money back here, so we're earning 0. We're just getting our money back here, so we're earning 0. Let's see what we earn on project C. So since these cash flows aren't all the same, we can't use the third row of our calculator, but we can use the CF menu. So we go into the CF menu and it asks us what's our cash flow at time 0. In other words, what's our initial outlay? It's 1,000. Change the sign because it's dollars out. Enter down. Then it wants to know the first cash flow. That's 900. Enter down. And how many times do we get that? What's the frequency of that first cash flow? 1 time. 1. Enter down. Second cash flow is $100. 100. Enter down. And what's the frequency of that? How many times do we get that? 2 times. 2. Enter down. And now we'll ask the calculator, what's the internal rate of return? What does this project earn? We'll hit IRR and then compute, and it tells us this project earns 7.8656. So if our money costs us 7%, we'll invest in a project that earns 7.86%. If our money costs us 8%, we won't invest in this project. So the cash payback method is a good first cut and may have been valid many years ago, but nowadays a much better method is either to use the net present value or the internal rate of return. Those methods take into account the time value of money and help us rank our projects to figure out which ones we want to do.